Can you put a house inside of a trust if it's paid off? It's actually much easier if it's paid off. You don't have to worry about the banks getting permission or refinancing that property. And so you could do either a revocable or an irrevocable trust. Typically, people get tripped up with the irrevocable trust because it triggers the due on sale clause if you do have a mortgage, and they will call the remaining balance of your loan due. Now, if you want to put it inside the trust, what you can do is, one, decide which type of trust you want, revocable or irrevocable. Revocable avoids probate. Irrevocable, it gives you asset protection and avoids probate. Two, once you have your trust set up, you use a quitclaim deed or warranty deed to transfer the property into the trust. You file that document at your county clerk's office. They will process that document, transfer ownership out of your name into the name of the trust. And because you don't have a lender, you don't have to update your bank and give them any information related to that. You're done. You want to make sure you're updating your insurance policy. If you have a revocable trust, you add the revocable trust as the additional insured. If you have an irrevocable trust, you are setting up a brand new policy with the irrevocable trust being the named insured, and the trustee will manage that policy. And you're good to go.
It is absolutely true that there are a lot of challenges when trying to transfer a property that you own from your own name to any third party when there is mortgage in place. And that's because there's a clause in the agreement called the due on sale clause, which gets triggered anytime that third party transaction takes place. However, there is a workaround called the Garn-St Germain Act, which permits you to transfer the property from yourself to another ownership structure so long as you're still the beneficial owner. And that's why a revocable trust is a perfectly suitable transfer, because the revocable trust is your alter ego and you get to reside in that property. You're still the beneficiary, if you will. So the Garn-St Germain Act is your protector. But it's also possible to leverage with properly structured irrevocable trusts. A QPRT, as an example, permits you to live in that property during your lifetime. So you're still the beneficial owner, thereby being able to be protected by the Garn-St Germain Act. But it's important to note, what is the purpose of doing this? Are you doing this as part of an estate plan strategy, an asset protection plan, or a generational wealth blueprint? To figure out what the best approach is, you must first learn the rules of the game. If you want to learn what some rules are, drop the letters GOB and I'll send them your way.